With 2012 coming to a close, it's time to review the year and look ahead to 2013. I'm Andrew Stotz of Maybank Kimhang, and I started my Stotz stocks portfolio in mid-January this year, and it's now up 43% versus 28% for the Thai market. My best picks more than doubled. Jazz was up 160 and STEC 100%. My two worst picks were Thaikom and Thai Oil, both which were down 18% for the time I had them in my portfolio. My focus for 2013 is a theme I call Building Asia. But before I get into that theme, let me highlight the changes I'm making to my portfolio. I'm removing two consumer-related companies, MAKRO and MBK, and replacing them with two infrastructure construction-related companies, STPI and TTCL. Now, let's review my thoughts on global markets through a series of charts. This chart shows the efforts the U.S. federal government, or the Federal Reserve, has made to reduce long-term government bond rates to near zero. Over the last 7 years, those rates have fallen from 5 to 0.7%. But what is significant to me is that rates only fell 20 basis points in 2012. This shows that rates are potentially reaching their bottom. And if this is indeed the case, then the days of the bond market beating the stock market are probably over. Next, I consider financial risks across the globe. This chart shows that the U.S. consumer is deleveraging at a very fast pace. Another remarkable chart shows that the U.S. companies have now deleveraged to an all-time low. They now match the low levels of leverage found in Asia. In other words, the financial risks at U.S. companies is now very low. Now, the level of U.S. bank capital is also improving, while in Asia, bank capital remains extremely strong. Europe has the lowest level of bank capital, and this, combined with the euro crisis, means the lifeblood of the eurozone economies slows down. But the most dramatic issue related to risk is the massive acceleration of debt by the Western governments. It's crazy. The government debt of the largest 7 developed countries is now breaking through 120% of GDP. This is higher than it was after World War II. Meanwhile, emerging markets' government debt has actually started falling. So where would you rather put your money? Well, I prefer emerging markets. My global recommendations are clear. Overweight emerging markets and underweight the US. But I go a step further by showing the exact ETFs and weightings I recommend so that you can better track the success or failure of my recommendations. In the future, I'll publish the performance of my recommendations on a regular basis. Now, let's consider which Asian markets are most attractive for new monies. To assess this, I consider a variety of factors related to the economy, earnings growth, and valuation. Well, let's start with the economy. When I look at an economy, I start with consumers. Now, if wages are rising and unemployment is low, then consumers will spend. If they're spending, then companies will expand to meet this increased demand. This expansion causes the revenue of companies to rise, which drives up earnings. Of course, earnings drive the stock market. Now, if consumer spending remains high, then companies eventually borrow to expand their capacity. This causes bank earnings to rise, which is also positive for the stock market. In addition to this, consumers can borrow from banks to turbocharge their spending. This increases demand and increases bank earnings, once again positively impacting the stock market. Of course, economies are also driven by government participation and trade with other countries. Now, I illustrate these interdependencies in charts related to consumers, corporates, governments, and banks. This diamond analysis is the framework I use to evaluate economies to build my investment recommendations. Now, my recommendations for Asia are overweight China, Thailand, and Korea. Now, how do I arrive at this? Well, I bring together my economic analysis with fundamental and valuation factors. Let me illustrate my process. So why am I so positive on China? Well, let's walk through the charts to see. First, GDP is nearly equally driven by consumption and investment. Second, China is cheap on every measure of valuation, with EPS growth being the only negative. But if market is very cheap, I'm willing to buy before EPS turns positive. Finally, when I look at valuation, I can see that China has fully deflated from its 2007 bubble and is now in what I consider my buy zone. So my recommended weights for Asian markets are China, Thailand, and Korea, each 25%, 15% for Malaysia, and 10% for Singapore. Again, I will benchmark the performance of these recommendations by using ETFs and compare my result against owning just Asia ex-Japan. So let's get down to Thai sectors. I'm positive on the telecom and energy sector and negative on materials and consumer staples. In fact, I've downgraded the consumer staples sector due to its high valuations. Finally, in my Thai stock portfolio, I'm removing MAKRO because the share price run has stretched valuations. Also, I remove MBK, which is a good value stock, but I doubt whether the share price can really perform given the big drop in profits in 2013. Now, let's revisit my theme for 2013, which is called Building Asia. We all know that the West is buying less from Asia, and as a result, exports have been weak. This has caused some investors to be very negative about investing in Asia. But anyone on the ground in Asia can see the growth in wages and employment and switch that's happening by companies as they switch to supply the domestic markets. The problem is this theme is already close to being played out, with the consumer sector in Asia now overvalued. But remember from my diamond diagram that consumer demand eventually leads to expansion at companies. It is this expansion, this building of Asia capacity, that I want to play in 2013. Now, to play this theme, I'm adding two stocks which are building Asia's expansion. One is STPI, which has a $1 billion contract to build an LNG project in Australia, and the other is Toyota, which is an engineering, procurement, and construction company that is building petrochemical and energy facilities across Asia. Both stocks have had strong runs in their price, but don't let that stop you from considering them. They are still cheap and have strong growth ahead. So that wraps it up for 2012. I hope you had a great year like I did, and that 2013 will be even better. Thanks for being with my Stotz Stocks team this year.